Well, the Fed did it again. They lowered interest rates one more time in 2025. But the question is, what does it mean for your hard-earned retirement savings? Well, stay tuned. This week's episode of the Retirement Income Source, where it's all about your income.
Thank you for listening to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we appreciate you spending some time here with us this weekend. And Dave, it wasn't exactly unexpected, the Fed lowering interest rates once again, but for a lot of people out there, they're probably wondering, how does this affect us? What does this really mean? And really, at the end of the day, what it means is that this could be a winnowing, narrowing opportunity for folks to make that transition to income, to really maximize the amount of income that they're able to get in retirement.
Well, of course, it could be because ultimately when you earn income on your investments, the way we always talk about on the show, Sarah, you're talking about getting interest and dividends, right? So we're not talking about using the withdrawal method, taking withdrawals and hoping that your principal grows back from year to year, actually taking the renewable resource of interest and dividends, of income. And of course, when interest rates go down, it means the amount of interest and dividends you can get per dollar of principal also goes down. But first, why is the Fed doing this, right? Because it's interesting. Younger folks like it when interest rates are low, right? Because you go out, Sarah, you get a mortgage on a house. When interest rates are low, you could buy more house, right? Yeah. You want to finance a car, you could buy more car.
It helps you during that growth phase of life.
It helps you when you're younger because you're a net borrower. But when you're a net equity person, right? Meaning you have more equity, you're not borrowing. When you get closer to retirement or are retired, now you want higher interest rates because you want to be able to live off that interest. So why is the Fed doing this? Well, first of all, it's always got to do about stimulating the economy. The Fed has really two tools that they can use to stimulate the economy or to slow down the economy, like they did a few years ago when they were concerned about inflation. The first tool is short-term interest rates, right? If you lower short-term interest rates are literally set by the Federal Reserve. If you lower those rates, then in theory at least, people will be more apt to borrow money. Companies will be more apt to borrow money to make capital improvements, to buy equipment, or maybe to hire more people, right? So it helps stimulate the economy at lower interest rates. Higher interest rates does the opposite. It makes borrowing more expensive, and it rewards savers more. So individuals, companies don't want to spend, they want to save when rates are high. When rates are low, they're not earning as much, so why not borrow some money and buy something, which ultimately will stimulate the economy. That's the theory behind it. Because the other tool is very indirect. The other tool the Federal Reserve has is whether or not they indirectly affect long-term interest rates. Because they don't set long-term interest rates. What they do is they indirectly affect them by buying bonds or selling bonds in the open market, right? When they buy bonds, they create a demand for the bond, which drives up the price, which drives down long-term interest rates. When they sell bonds, they flood the market, and therefore the price of bonds goes down and the long-term rates go up. But again, that's driven by market forces, of which the Federal Reserve is only one player. So that's why this is happening right now, why the Fed is looking to lower interest rates, because they realize they're probably back on their heels a bit with an economy that's been slowing down.
Yep. And there's a lot of people that want to, I'm sure, be able to take advantage of this. Like I said, it's a narrowing opportunity to maximize those higher interest rates. And if you're interested more in learning more about those income generating investments, I urge you to check out our website. It's incomeradio.com, where you can download a free white paper. It's a guide that we put together on the universe of income generating options. So you can learn about all of the different tools out there for you to use. And once again, we appreciate you listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we're talking about the Federal Reserve's recent move to lower interest rates, really what it means for the big picture and how you can take advantage of what's going on right now. So Dave, just a few moments ago, we were talking about what the Federal Reserve is doing by lowering the interest rates, voting to cut the rates, and what that really means for the economy and their outlook in the economy. So typically when they lower the interest rates, their goal is to stimulate the economy. Can you talk a little bit more about that, like what we're seeing right now?
Well, the interesting thing is the Fed isn't really necessarily seeing it, but they're getting pressure from corporate America. They're getting pressure from the administration. The Fed has we talked about the two blunt instruments they have to affect the economy, and that's by directly lowering or raising short-term rates, and also by how they can indirectly affect long-term rates by buying or selling bonds themselves, creating a demand or lack of demand. Well, their instruments for detection of problems are even blunter, right?
It's basically a rear view mirror.
It's all rear view mirror, right? They're looking at what happened over the last quarter or the quarter before, and by the time the trend actually changes it, and by the Federal Reserve often sees it, the momentum in one direction or another is built. This happened several years ago with inflation. By the time they really acknowledged and saw the inflation, the momentum was so strong, we got up to, I think, a 9% annualized inflation rate one year, right? And the same is true when they see the economy slowing down. By the time they see it, there's so much negative momentum, it takes forever to fix. So that's why business leaders, that's why the current administration is trying to push them to make this change, because we're starting to see it in corporate America. And the interesting thing is, a lot of people listening, a lot of you may not see it. You may look at your mutual funds and you might say, wow, I'm still making money in the stock market. The stock market's doing well. The economy must be doing well. Well, understand a lot of what's happening right now, why the stock market's doing well, is because of the AI stocks, right? All the artificial intelligence, all the technology stocks. And because the way most mutual funds and the way the S&P 500 is weighted, it's weighted toward technology. And when these stocks run, it makes it look like the stock market overall is doing well, when the reality is it's not doing that great. It's still doing okay, but it's slowing down. In fact, the economy is still growing. It's just growing at a slower pace. And see, that's the thing. If you wait till the economy shrinks, it's too late. It takes forever for the lowering of interest rates to have any effect. So as soon as you see the growth rate on the economy start to slow down, just growing at a slower rate, that's when the Fed needs to make a move. And some argue that with the three small cuts they've made this year, they might already be behind the curve in that effort.
Yep. What do you think, Dave? Especially for folks that are out there listening, that are at retirement age, or maybe just a few years away from it, that are weighing that transition, saying, "Hey, maybe I should make that transition now," but maybe they're also struggling with that FOMO, right? That fear of missing out, and they don't want to get out of the growth in the stock market. They're worried about missing out on that growth.
Well, as one of our advisors in Cheshire, Connecticut, or as you like to say, Cheshire, Connecticut.
That's my Florida accent coming through there, Cheshire.
You know, Jeff says, he always says, when you're borrowing, you want to refinance when interest rates go down. When you're an investor looking for retirement, you want to refinance when rates are high. And the fact that rates have only dropped by essentially 0.75% so far means they're still reasonably high. So if you're going to retire, let's say more than 5 years from now, and especially if it's closer to 10, okay, maybe you could change a little bit into an income first, capital appreciation second mindset. It's not as much of a rush, but certainly if you plan to retire in the next 5 years, you might want to take advantage of the fact that rates are still pretty high, but they are trending downward.
Yep. How long do you think before that opportunity closes? Maybe another 6 months or so, a year?
Certainly within the year. I think the Federal Reserve wants to slow down on the amount of, do you want to kind of take a wait and see, maybe keep rates where they are for a few months. But, that may just make the effect worse, where now all of a sudden, when they do lower rates even more later next year, they may have to lower them by a lot. So I certainly wouldn't want to push my luck past the first half of 2026, Sarah, certainly if I were within 5 or maybe even 7 years of retirement. And coming up, we'll talk more about one of my favorite topics, is that also important gradual transition from being growth-based, regardless of where it comes from, to being an income-first, capital appreciation second investor, and why now might be the perfect time to make that transition. I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about your income.
Welcome back to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we're talking about the Federal Reserve's recent decision to cut interest rates and what it really means for you, especially if you're in that important time period, that transition period when you're maybe 5 years or less out from retirement. And Dave, you talked about the Fed only they have really two tools that they can use, where they actually they lower the interest rates, the short-term interest rates, and they try to indirectly affect long-term interest rates by selling them and creating more supply in the market. But what about those listeners that are in that transition period, this really important time where you want to get things right? In light of the news of interest rates going down. Is now the time to make that transition?
Well, it seems like it would be that for me, yes, if you're within 5 or maybe even 7 years of retirement, because, when you're younger and you're accumulating, you want your money to grow. You don't care if it comes from the income from interest and dividends, or whether it comes from capital appreciation, where investments go up in value. Either way, it's real money for you. Your account balance is something you just want to grow, so you have more money to generate income during retirement. But as you approach retirement, you go to what's called an income first, capital appreciation second approach, where first you're looking to generate interest and dividends, income that in retirement can get paid to you. It'll just be reinvested in the early years. That's okay. And you still want some capital appreciation. You still want your investments to grow, but it's not as important anymore. Why? Because you can't spend growth in retirement, right? You can spend income, you can spend interest and dividends, you can't spend growth. And Sarah, as you know, most of the advisors that try to spend growth, what they're really doing is they're withdrawing principal for their clients every year. They're calling it income, when really it's not income, it's just cash flow, it's a withdrawal, and they're crossing their fingers and toes and hoping that it grows back in the next year. Yep. And, advisors, in many cases, think that, hey, hope's a strategy. Well, our listeners are too smart for that, and I'm sure you know that, hope is not a financial strategy when it comes to your life savings. And so why is it not flipping a switch, right? Why is it not the day before you retire, you go from, just wanting your money to grow, irrespective of where that growth comes from, the interest and dividends, the income, or the CA, the capital appreciation, to an income first, capital appreciation second mindset? Why isn't it that? Yeah. Well, because when you're ready to retire, you want two things to be true to get maximum income. Number one, you want the capital appreciation to be high. You want the market to be high. But number two, when you transition those market-based investments to something that's more income first, which could still be market-based investment, just dividend stocks, you also want to do it when interest rates are high, so hopefully that bigger sum of money will be generating more income, right? The problem is that you're looking for two variables to be working perfectly at that same time. And the reality is, if you flip a coin once, you have a 50% chance of getting heads. If you flip it twice and want heads both times, it's 25%. So randomly speaking, there's a 25% chance that if you wait till the day before you retire, the markets will be high and the interest rates will be high. It could be worse. Both could be low, and then you've gotten tails for both coins. So that's why it's not like a light switch. It's more like a rheostat. It's something you gradually turn in those 10 years leading up to retirement, going from that growth mindset, regardless of where it comes from, to an income first, capital appreciation second mindset. And right now, what we know, Sarah, is we know the markets are high because capital appreciation has done pretty well, right? We know that. We don't know what's going to happen next year or the year after. In fact, we're due for a pullback in the markets for sure. And we know interest rates are still pretty high, but on their way down. So I think it's foolish to just wait and gamble for the absolute highest market and the absolute highest interest rate, because that would take a lot of luck to be correct on both levels.
Yep. It's better to make that transition now when you have more opportunity. But really, at the end of the day, Dave, anything is better than using that withdrawal strategy, where really what your advisor doing is selling off your assets, selling off your shares, because that's your opportunity to actually be able to generate that income. That's extremely important. So if you have a question, we would love to hear from you. We're going to be featuring some of your retirement questions coming up in just a few minutes. So please give us a call. Our phone line is open now. It's 833-RIS Radio. That's 833-747-7234. You're listening to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we're talking about some current events, including the Federal Reserve recently lowering interest rates. Dave, we've been talking about why this is really a great opportunity for folks in that transition period, those folks that are just maybe 5 years or a few years less out from retirement, why they need to make that slow transition into having the income first approach instead of focusing on that capital appreciation. Because you would like to sell when both things are high, right? When you're in a good place,
that's right,
versus having to hedge your bets and do the best with what you have.
That's right. And if somebody has transitioned a bunch of it already and they're 5 years out of retirement, not a big deal. But if you haven't in your 5 years out of retirement, you might want to, read the tea leaves and say, yeah, it's time to do something here, because again, the Federal Reserve has blunt instruments in terms of how they affect interest rates to try to stimulate or slow down the economy. But what's even blunter is their instruments for detecting when we have inflation, when we're in a recession, right? So it's like recently I was out there doing some currency training in the airplane, and every 6 months as an instrument rated pilot, you have to have logged 6 instrument approaches and a hold and intercept airways. And you have to log it, and you have to have somebody with you to say, this is legitimate, it's really happened. And you put these glasses on that cover up your eyes, so all you can see is the instruments. And I'm thinking about how grateful I am, because the instruments these days are so, there's like 3 different ways on your instruments to cross-check what's ahead of you. Maybe 4 different ways depending upon how you have your screen set up. And even when I started flight training, it wasn't that advanced, but still, all the instruments were forward-looking. So it might be more raw data you have to interpret while you're in the airplane, but they're forward-looking. The Federal Reserves are all backward-looking. And to me, they need to take more advice from business that sees what's happening, that sees trends, and to use that to make decisions. And they just don't see in tune to do that. So why does this matter to you as somebody approaching retirement? Well, again, it means that if the Fed is always slow to act, whether it's raising rates like it was a few years ago to combat inflation, or lowering rates like now and many times previously, you have to say, well, gosh, if they pause first half of next year and there's really signs of inflation, rates may go a lot lower and stay down for a while, which is why, again, I'm saying I believe that right now, with having only lowered 3/4 of a point interest, it's still a good time for those people who are a bit behind the power curve, making this all so important transition.
You can maximize your interest rates. You can still maximize that income because we still have a little leeway, right, Dave? You said maybe at least 6 months to a year or so. There's still some time here to make that transition. Yeah,
sometimes people want the best, right? You want to get out. You want to time the top of the market when you get out. You want to buy in the market at the lowest point. You want to lock in interest rates when they're at the highest. Well, the problem is a lot of times, more often than not, when you gamble waiting for that perfect number, you end up getting a worse number. You get in or out at a worse point because you get a little bit too greedy. And as they say, pigs get fat and hogs get slaughtered, so you have to be careful and just say, where is the market now relative to history? Where's interest rates relative to history? And it's still pretty high, so let me take advantage of that. Right.
You can't get too excited or too hooked on that gambler's high, right? Because eventually the luck runs out, and it's not a great strategy to build your retirement on.
And people do that all the time, Sarah. It's amazing. They always try to get that perfect timing, and it's because it's a bit of a game. You always want to feel like, hey, I got a great deal. Well, be careful. This is your retirement. You're not buying a car where you're saving $1,000 off the price because you negotiate harder than the next person. This is a retirement where missing this also important step could mean you're stuck working for another 5 to 10 more years.
Absolutely. Well, if you have a question, if you have something that you would like to know about something we've talked about on the show recently, or even just about retirement in general, we want to hear from you. Please give us a call now. Our phone lines are open. That number again is 833-RISK-RADIO, 833-747-7234. Or you can go on our radio website. It's incomeradio.com and send us your questions through there. We'll be right back. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about your income. Thank you for spending some time here with us this weekend on the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton. If you're wondering what the recent moves from the Federal Reserve regarding interest rates mean for your retirement, that's what we're covering today, and why it might be the last chance for you to really lock in on those higher interest rate investments, which really mean more interest and dividends in retirement. So, Dave, this is most important for people that are really in that transition period, we call it, which is when you're a little bit less than 5 years or so, maybe 3 to 5 years out from retirement.
Mm-hmm. It is. And, we talked a lot about the importance of the fact that interest rates have come down a little, but they're still pretty high and the market's high. Well, the reality is, like I said, if the Federal Reserve gets behind the curve on this and there's a worse recession, you're going to see the market come down. Now, people are going to have less money in a lump sum. Then interest rates will be lower for longer, which means if they convert to income, they may end up with as little as half the income they thought they were going to have in retirement. And if that's the case, most people can't afford to retire. But oh, by the way, what happens when there's a recession, when the economy's bad? Well, people get laid off. Who gets laid off? Oftentimes the older people with, they're
Seniority,
earning the highest
they're making
incomes.
more money, right? More salary.
So it's like a triple whammy, and that's why I really, really, really encourage our listeners to take me seriously on at least if you haven't already, at least beginning this also important transition now.
Yeah. Well, we had a couple listeners that took us seriously when we had our call for you to call in to send us or to call in and leave us your Ask Dave questions that we can answer on the show. So let's get right into that, Dave. We have our first question here from Frank in Worcester. He says, my advisor keeps saying that my wife and I will have plenty of income whenever we retire in the next few years, but how can I be sure he's telling me the truth? All right, so Frank is a little bit suspicious. He's not sure if they're getting the whole truth from their advisor.
Okay. Well, first of all, congratulations on saying Worcester. Right?
I practiced for
most
that
people.
one.
Most people from Florida call Worcester, Massachusetts.
I got some help from our coach.
Good job. So Frank, that's a great question. Our advisors will often say you're going to be fine, you're going to be fine, going to be fine, because they're using something like that outdated 4% rule, right? Where they'll say, oh, you've got $2 million. That means you can take $80,000 a year. 4% of $2 million is $80,000. You could take it for the rest of your life, and you'll probably never run out of money. But you don't really know whether they're just living off that renewable resource of the income, right, the interest and dividends, or whether they're taking the withdrawals and crossing their fingers and toes and hoping it grows back. Because the latter is clearly much more dangerous than the former. So how can you tell? Well, the first thing is if you're with an advisor, you probably have brokerage accounts through a big wirehouse or through maybe an independent clearing firm like a Fidelity or Schwab, and you might have a column on there that says income or says yield, right? Mm-hmm. And it's either going to give you a dollar amount of income, which should be added up on the bottom, where you take the income and divide it by the lump sum, and it tells you, what percentage is being generated from the I. Or if it's yield, it might actually give you the percentage, and then you can see what that is, right? And then you subtract your fee from that. So let's say if you've got $1 million and it's $25,000 a year of income, that's 2.5%. But if you're paying your advisor a 1% management fee, that means your advisor's getting 1% and you're only getting a 1.5%. So you'll be getting $15,000 of true income off a $1 million balance, right? Now, what if it's not on your statements? Well, then you have to go to your advisor and say, okay, what is the interest and dividends on this? Give me the annualized amount. And find out, just ask that question. If you have money in a 401k, Frank, it might be even more challenging because in a 401k, they never have an income column there. Never. Why? Because, again, 401ks are for people in their accumulation years that are younger, that are saving, that want to grow their money, and they don't care whether it comes from the income, or whether it comes from capital appreciation, something going up in value. So that's why 401ks never have that, all right? But that's what you need to do. Find out from your advisor. And I guess if you have a 401k with mutual funds inside of it, you can always look up those mutual funds or give them to your advisor and say, hey, what's the income yield on these funds that are in my 401k, even though you're not managing it? And then you'll know. What can you get? Well, with an income first, capital appreciation second strategy, you can get 5 or even 6 or even 7% before fees, which if you're paying a 1% management fee means 4, 5, or 6% after fees. So if you're not anywhere near that, then you're probably not working with a true income specialist. You're probably working with an advisor who's a generalist who works with you, but also works with people in their 20s, 30s, and 40s.
Frank, thank you so much for sending in your Ask Dave question. That actually came through our website, incomeradio.com. And Frank, we're going to make sure that you get a free copy of our white paper, the guide that's all about the universe of income generating options. That way you can truly understand more about all of the income generating options out there so you can trust your advisor, or maybe you need to fire your advisor and work with an income specialist to generate income the right way. And if you have a question, make sure that you get into our website. We can send it to us from there. It's incomeradio.com. You can also call our phone line. That phone number again is 833-747-7234. Okay, our next question here. We have Alice from Avon in Connecticut. She says, I'm a bit behind on saving for retirement. I really want to retire in less than 5 years, but I haven't made a transition to income first yet because I'm so behind.
All right, Alice. Well, I guess the question is, how behind are you?
She said, I'm a little bit, and then she said, I'm so behind, so it's hard to judge.
Yeah, no, I see that. No, Alice, look, if you're a little bit behind, and you still want some from the capital appreciation from the CA, you can always use higher dividend stocks, right? Higher dividend stocks have not done well the last, call it 2.5 years. All the high growth stocks have been doing well, the technology, right? But that's eventually going to turn where those stocks are getting pretty pricey now. They're getting high, and it's going to turn and go to the income generating stocks. In fact, with interest rates coming down, the income generating stocks actually start to look more attractive as an income option, right? So that may be one way that you can have your cake and eat it too. You can move some money to an income first, capital appreciation second approach and still have some upside potential, right? You don't have to put it all in bonds. You could use higher dividend stocks. But if you're really behind, really behind, then it's a little different. Then, where no matter what happens, you're going to have to work longer. Then you may have to just roll the dice and stay in the markets, for a longer period of time. But I'd say if you're 75% there, then, you use the high dividend stocks as a potential way to have your cake and eat it too, be able to make partial transition and still get some upside. So, love to talk with you. If you want to give us a call, you want to write back to let us know how far behind you are. Hopefully you have a target of how much money you'd like to accumulate by retirement and how much you have, and determining based upon how far behind you are and how many years you have, then we can give you a more specific answer. So, Alice, I hope that helps.
Alice, I hope you're listening. Again, we'd love to hear from you so we can give you a more specific answer here. That phone number is 833-RIS-RADIO. That's 833-747-7234. And a big thank you to all of our Ask Dave listeners, our Ask Dave participants who sent in or called in with their retirement questions. We love answering your questions every single week because really, Dave, we know that we're helping people out there, helping people understand why making this income first transition is in their best interest.
And we have a niche. The thing is, I don't care what anybody says. You can't be good at all things for all people. You just become jack of all trades, master of none. And that's why this niche is so important. Those people who are within 10 years of retirement, either side, whether you're going to retire within 10 years or you've been retired for less than 10 years, that's where a mistake is the most costly and can destroy someone's retirement. And that's why that's such an important niche that we own.
People tend to forget the second part of the jack of all trades saying, right? The master of none. And,
that's right.
And when you need specific advice, when you need an expert, you really need to go talk to a specialist that can help you with this. And most of all, thank you so much for listening to the Retirement Income Source, where it is always all about your income.
And most importantly, we hope that you're here with us next week. Same time, same station. I'm David Scranton. We're here with Sarah Samuels. And this is the Retirement Income Source. And yes, it's all about your income.